because tomorrow I'm also going to be occupied tomorrow. All right. All right. Uh, All right. So today is the second session, right? All right. So I went through your assignment and you did a very, very good job. Okay. So what we are going to do today is the second session, day two, which is obviously liquidity. Today's day two, right? Yes. Liquidity. Okay. Liquidity, then supply and demand. All right. So let's go back to the chart. Now, whenever you hear liquidity or anytime somebody tells you there's liquidity in the market, all right, I want to ask you a few questions that what comes to your mind whenever you hear the word liquidity. All right. It's money, okay? Exactly. Exactly. So in other words, liquidity is like a means to complete a transaction. Okay, there's always a transaction going on in the market because we have people who are buying and at the same time we have people who are selling. So liquidity is like a tool to complete a transaction. All right. My style of trading is like a style of trading that is basically on liquidity, which means we focus more on liquidity because there's no way a move is going to happen without a liquidity being taken. So that is the basic way I can explain my style of trading, which means you have to understand liquidity in depth, all right, across every time frame. Okay. So now let's take a look at the 1 hour time frame. All right. You're going to see that on the 1 hour time frame, before we have a push to the downside or a push to the upside, we are most time gonna have what's either a high or a low being taken. It is a must. Okay. You're going to have either a high or low being taken. It is a must. All right. The moment you don't have a high or low being taken, possibly price mitigates something. All right. What is going to tell you is that price is trying to build liquidity. For example, we have this right here. Whenever you see a mitigation happening without liquidity being taken, it simply means one thing, which is what? Price generating liquidity, price building liquidity for a future move. All right. So you would see that every move that happened, every impulsive move that happened, we have a swing high or a swing low being taken. Okay. Yeah. So the first type of liquidity we're going to look at, in which that is general, is what? The swing high and the swing low. Okay. The swing high and the swing low. So how do we define a swing high and a swing low? We define a swing high and a swing low with three different candles. We define swing high and swing low with three different candles, which means you need to have a candle at the center which is higher than the candles at what? The both side. All right. You need to have a candle at the center which is higher than the candles at both sides. So you get to have this Okay. So this gives you what? A swing point. So every possible swing point you see in the market created across every time frame, all right, is what? A very, very, very strong liquidity level. No matter how the swing high or swing low is being created, it is a very, very strong liquidity level. Okay, so let's take a look at some. I hope you are listening to me. A typical example is you can see that we have a candle right here. Okay, we have a candle right here, a bearish candle, and a bullish candle. So which means this candle at the center is lower than the candle you have at what? At the both side. So this defines what? This is a swing low. All right. This is a swing low. Okay. Then you have this candle, you have this candle, and you have this candle. But the candle at the center is lower than the candle on the left and on the right, which means this is a swing point. So that's basically how we define a swing point. Okay, so every swing point, every possible swing point you see in the market has what? A very, very strong liquidity level. Okay. All right. So that is what we mean by a swing point. Now, there are some times whereby price will create a swing point and it might not be taken immediately. Possibly price is trying to create the swing point for later. Okay, either it is being created now or it is being created later. Price is going to come for it. All right. So every swing point you see in the market is a very, very strong liquidity level, as long as it is being categorized under swing point. So the next type of liquidity level we are going to talk about is sessions liquidity. All right. Session liquidity is the next type of liquidity we are going to talk about. So we have 5 different sessions. We have 5 different sessions. All right. Can you name them for me? How many sessions do we have? Can you name them? Okay, remaining one. Yes. Yes. So we have Asia. You have Frankfurt. We have London. So I'm going to explain session liquidity for you, and you need to pay a very close attention. And we have New York. And the last one is Sydney. Okay. So what is session liquidity? Session liquidity is that theoretically every session creates a liquidity above and below each session. Every session creates liquidity above and below each session. All right. So let's assume we have Asia right here, which means most time you basically have Asia in a range. Okay. If this is Asia, Frankfurt, we either take the Asia low, which is this, all right, or take the Asia high, which is this. That is what Frankfurt will do. Okay. Frankfurt will either take the Asia low by doing possibly this. Frankfurt has taken Asia low. Then you have a range like this. Okay. Now we have this as what? The Frankfurt high, and this is what? The Frankfurt low. All right. So London will do what? Possibly push to the downside. Okay. Then going forward, London, Frankfurt high, and Asia high. Then you see a possible retracement happening. Okay. What does New York do? New York might do this, Frankfurt high, then the heavy drop towards London low. Okay. This is a basic schematic of a session liquidity. I'm going to show you on the chart, and I think it happened today. So you don't get to see it all the time, but trust me, the previous session serve as what? A liquidity for the next session. Okay, so then you have Sydney creating this. All right, so this is New York high. Okay. Let me see if this. All right, so let's see it on the charts. We have an indicator for that. All right, we use the session box indicator. Yes, this is the indicator. All right, so the green box is Asia. Between the green and the red box is Frankfurt. The red box is London. Okay, between the red and the blue box is pre-New York. It is a 1 hour window. Remember what I told you, that we have a pre-New York timing. So this is a very, very strong reversal confirmation between this window. Don't worry, we'll talk about timing later. Then we have New York itself. Okay, so what happened today? We have what? Frankfurt did not take neither the Asia high nor the Asia low. Okay, but we have London taking the Asia high, and we have pre-New York / New York taking what? The London high. Okay, then we have New York going forward, London low right here, and what? Asia low. Okay, let's see another example. Another example is this. Okay, we have this as what? Asia. Look, this is a very, very strong example. We have this as Asia, right? We have Frankfurt going forward, Asia low. We have Frankfurt going for Asia high right here. We have London going for Frankfurt high, and London going forward, Frankfurt low, and Asia low. Okay, we have pre-New York / New York going forward, London low and London high. So this is a typical example of session liquidity. It's like a confluence that we use for entry and targets. Okay, let's see another example. I'm going to send you the settings for the indicator. All right. So you have this right here, London taking Asia low, Asia high, and what? Frankfurt low plus Asia low. Then you have a mitigation by New York taking London low and what? London high. All right. All right. So this is session liquidity. Now, the theory is that every session high and every session low consists a very, very strong liquidity for the next session. I don't think you understand me. The current session, the high and the low is a liquidity target for the next session. So if you are picking a supply or demand zone at a session high or low, it is what? It is most likely going to be what? A low probability one, just like this. All right. So you're picking a supply or demand zone at a session high or low, it's going to be a liquidity level. So why is this a liquidity level now? During London, we have people who are selling from here, possibly selling to the down. You know, we have people who are also waiting for the retest of this for them to keep selling. All right. Then we also have people who are buying from this low. And at the same time, we have people who are looking forward to find a buy continuation when price get to this level. Okay. Exactly. Yes. Yes. So that is what the session liquidity is all about. And I hope you understand now. All right. So the next one we are looking at is the previous daily high and the previous daily low. I'm sure you are very familiar with that one. Your PDO and PDH. So you can see that I'm showing you what liquidity, how liquidity has been, how you should see liquidity. The moment you understand liquidity in depth, it's going to give you a very, very strong insight. So we have, let's say, Monday, we have Tuesday, the same explanation I gave for session highs and low is also the same explanation that is going to apply for the previous daily high and the previous daily low. We have Thursday and we have Friday. All right. So on Monday, the same ideology I explained to you that you have session highs and low. All right. Within Monday, you're going to have something like this. Okay. Now, write this down. About 80% of the time, price will go for either the previous daily high or the previous daily low. About 80% of the time, price will go for either the previous daily high or the previous daily low. All right. So the previous daily high contains a very, very high amount of liquidity we have here. Okay. So Tuesday, what is Tuesday going to do? It's going to do what? Go for either the previous daily high or the low or both of them. Okay. So this is Tuesday high and this is Tuesday low. You get to see price coming for either then a drop to the downside, for example. Okay. So this is Wednesday low and Wednesday high. All right. This might not be a perfect schematic, but trust me, you're going to see it most time. The high or the low of the previous day consists a very high amount of liquidity. Okay. So the next day, which is Thursday, might go for the previous daily low. Then Friday goes like this. Okay. Do you have any question or are you following me? Okay, yes. All right. So the thing is, how you're going to understand which is protected and which is likely to be taken is that, do you trade Asia? Yes. Yes. That's what I asked you. Do you trade Asia? If let, let me give you something. Whenever you have Asia taking the previous daily high or low, or Asia taking a very strong liquidity level, a high time frame liquidity level, expect that day to be a trending day. Anticipate that day to be a trending day. If you have Asia, continue buying exactly. That is going to you're going to be working with your trend. Okay, until you have a high time frame liquidity taking. All right, you're going to have price just trending to one direction. So that is why you have to focus more on your higher time frame liquidity. Yes, sure, you will. So let me give you an example of a trending day. Let's say you have price. There are some days where price you just protect Asia and keep buying to one direction, right? I'll show you an example of a trending day. An example of a trending day is this. Okay, you can see price just selling to the downside because no liquid, we still have a liquidity to be filled the next day. That is why you have Asia just selling to one direction. Let me show you another example. Another example is it. Remember, I told you when Asia takes a liquidity, okay, you tend to have what? Price trending to one direction. Okay, price trending to one direction. Let me show you another example. Another example is okay, this is Sydney. Sydney took a higher time frame liquidity right here. Okay, so it is you are going to anticipate what a sell off the next day because you have what inefficiency and you have build up across. We are going to put everything together and you understand. Okay. Surely, I'm going to do that. All right, you don't need to worry. Okay. All right. So do you understand so far? Let's see an example of the previous daily high and the previous daily low. So an example is this. I said price will take either the previous daily high or the previous daily low at every single day. Okay, the previous daily low and the previous daily high. Now, write this down. The points where price is closer to the next day is most likely what is going to be taken. If price open and is closer to the high, you are more likely to get the high taken than the low taken. Another example is the price open the next day and we are closer to the previous daily high than was the previous daily low. The nearest liquidity, yes. All right, that's what I'm explaining to you. The previous daily high and the previous daily low. You can see that price open and we are closer to the low than the high. So most likely we are going to take the high and the low. We have the previous daily high right here and the previous daily low. Okay. Okay. So okay. Sorry, come and give me your question. Okay. Okay. Now let me explain something to you. Now, the explanation I gave you that every swing high and every swing low is a liquidity level. It doesn't mean that whenever price takes a swing high or a swing low, we are going to get a reversal. No. Okay. Now, coupled with the fact that price creates a swing low right here. Okay, let's assume this is swing low. Okay. The reason why price will not buy after taking this low is because this high is coming from what? Either a higher time frame liquidity level or a higher time frame efficient level. I'm going to show you an example now. An example is this low. Okay, price didn't buy to the upside, keep buying to the upside after taking the low. We had a reaction, right? The reason is because this high is coming from what? A daily efficiency. Okay, the high is coming from what? A daily efficiency. Look at it. So the origin of where price is coming from is really important. The origin of where price is coming from is really important. Okay. All right. So because price has taken the liquidity doesn't mean we are going to have what? A reversal. You need to check the origin where price is coming from. The reason why price didn't sell after taking this high is because what? We have this low coming from what? A 4 hours liquidity level. Okay, a 4 hours liquidity level, and we have what? A liquidity build up above. It's part of the plan. Whenever you have a liquidity build up above a swing high, and an example of a liquidity build up above a swing high is this. Okay, price is not likely going to hold because of this. Okay, yeah. So you should understand that every swing high and every swing low, it is more important to trade with the trend whenever a liquidity is being taken. Okay, so when we get to the trade plan, I'm going to explain deeply how to properly wake up in a day and trade. Yes, yes, inshallah. Okay. Are you with me? So yes, that is that for the previous daily high and the previous daily low. So the next one we have is a previous weekly high and the previous weekly low. Okay, the previous weekly high is the same explanation we have for what? Hello? Yeah, I can hear you now. No, yeah, monthly high and low is important, but not really important to us because we are more of day trader. So the weekly is enough. Oh, yes, 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 yes. So we don't really use the monthly high and low because the weekly is enough. All right, can you hear me? The weekly is enough, so we don't really focus. Yes, it's enough. All right. So do you have a question or? All right, so let's move to supply and demand. What do you understand by supply and demand? Okay, okay. All right, so supply in trading is like the amount of currency that people, okay, or their sellers are willing to sell at a certain price, while demand is the amount of currency that buyers are willing to buy at a certain price. That is a, that is a, that is a very straight definition. Okay, supply is the amount of currency or the amount of instruments that sellers are willing to sell at a certain price at a certain time, while demand is the amount of currency that buyers are willing to buy at a certain price at a certain time. Okay. So supply and demand is also as important as liquidity in the market because whenever you have liquidity not taken, remember I told you, whenever you have liquidity not taken, then obviously you're going to have what? A supply zone a mitigation, and that is price trying to what? Generate liquidity. Let's say, for example, you have this to the upside, okay, and you have mitigation to the upside. What this simply means is what? Price is trying to build liquidity. When price is returning back, this is not going to hold. This is a confluence. It's not going to hold. Okay. Whenever you see a mitigation and price has gone to the upside to take liquidity on the left, okay, when price is returning back, this is never going to hold. Okay. Yeah. So that is supply and demand. Now, before we, okay, uh, let me clear these drawings. So remember I told you to mark objective structure for me as an assignment the other time, right? I asked you to mark objective structure the other time for me. Okay? Whenever you have a break of structure, automatically you have a zone being created. This is a zone. You have another break of structure, you have another zone being created. Okay? You have another break of structure. The more structure you have, the more demand zone or supply zone price we create. So all these are demand zone. If you have another break of structure, you have another demand zone. All right. You have another break of structure, you have another demand zone. This is basically how supply and demand zone is being created. So the moment you have a break of structure to the downside, okay, you have a supply zone being created. If you have the break of structure, another supply zone being created. Yes, supply and demand, exactly. Got it. So in this case, that is why we have to look for a way. Since you have hundreds and thousands of supply and demand in the market, we need to have a way to look for how to properly have a criteria to select a valid zone and an invalid zone. Okay, a valid zone and an invalid zone. So let's see. Before we go to the criteria, let's talk about efficiency and inefficiency. So inefficiency in price. What do you understand by inefficiency in price? Okay. Okay. Um, Inefficiency is when price is not balanced. It's something as imbalance. Okay. The moment you have an unmitigated previous candle, price give you inefficiency. Okay. If you have this and you have this, let's assume this is a bullish candle. And this is a bullish candle. And you have another bullish candle. All right. Remember, I said the moment the third candle is not mitigating the high or low of the previous candle, that automatically gives you what? An inefficiency. Imbalance. They are the same thing. I don't want you to mistake them. They are just the same thing. Okay. This is an imbalance and inefficiency. All right. So if you have this low of the third candle, that is the week, giving you this, okay, automatically you have what? An efficient price action. Okay. Yeah. So this is an inefficient price action. And let's look at it in a fractal way. In a fractal way, if this is the 1 hour time frame, 1 hour on the 1 minute or 5 minutes. Okay, let's say 1 minute. On the 1 minute, you're gonna have like a multiple candles, many candles. So what you're going to see is this, for example. Okay. So on the 1 minute, you have this. Okay. So this is an inefficiency on the 1 minute time frame. That's the same thing. So if you are picking a trade on this mitigation, this is a low probability because it has what? An inefficiency that price needs to fill below. Okay. That is why it is always good to use your higher time frame inefficiency to determine your lower time frame inefficiency. Okay. Let's see some examples. I want to show you an example on the, let's say, 1 hour time frame. All right. On the 1 hour time frame, this is an inefficiency, right? You have this and you have this. Okay. Let's go to the 5 minutes or 1 minute time frame. Okay. So on the 5 minutes or 1 minute time frame, this is what you have. Okay. All right. Have you had any teaching concerning inefficiency before? All right. All right. No, you can ask now. Okay. Okay. All right. Okay. Okay. All right. So co- concerning EPA, the lowest time frame we go to is the 15 minutes time frame. Yes, for efficient price action. The 15 minutes time frame EPA is what we use. 1 hour, 4 hours, and the daily. If you are if you are picking an EPA, it has to be 15 minutes, something like this. Okay. 15 minutes upward. Okay. Okay. So this is not an efficient price action. Yes. No, no. M15, M15 is the lowest EPA you go to. Sorry. This is this is not an EPA. What I mean by an EPA is price giving you a mitigation. Are you listening to me? You need a mitigation. If you have this low, okay, this low coming to this is an EPA. Okay. Now, if you are picking this kind of trade, all right, I can as well say that you have an EPA because this is a candle. Can you see? But a liquidity has been taken, then you have a mitigation of this candle. Okay. This is an efficient price action, but this right here is an imbalance. It's here to be filled. Yes. Sorry, I don't understand. You mean this high? Okay. Because we have break of structure and price mitigated fully this. Okay, yes. Now we have IPA and EPA based on time frame. Okay, if you check my markup, you're going to see that you have I will name it 15 minutes EPA, daily EPA, 1 hour EPA, 4 hours EPA. That is how I name my EPA. Okay, it is good and better to understand EPA according to time frames. Yes, yes, yes. We use daily, 4 hours, 1 hour, 15 minutes. These four time frames. They are still the same thing. They are all the same. Okay. If you have an EP on the 4 hours time frame, right? And you go to the 1 hour time frame, obviously you're going to have an EPA. But you might have an EP on 1 hour, but and it's not going to give you an EPA on the 4 hours. The higher the EPA, the more likely it is going to be more valid. Do you do you understand me? That is why we use 4 hours daily and 1 hour, 15 minutes, these four time frames. Let me show you an example on the chart. This is the 15 minutes time frame, right? 15 minutes time frame. Let me show you an example. Okay, you have this, right? You have this. Can you see? Can you see? Can you see this? Now, let me show you clearly. Let's look at the 1 hour time frame. On the 1 hour time frame, you can see that you have another efficiency. This is the 1 hour efficiency, right? On the 15 minutes time frame, this is the efficiency it gave you. The more efficiency you have aligned together, the more price is likely to give you a reversal. Now, this is an efficiency on the 4 hours time frame because price is what mitigating this. So this is a very, very, very high concentrated sell zone. Okay, let's see daily. Okay, daily is not giving an EPA, but 4 hours, 1 hour, and 15 minutes are giving you what? An EPA aligned across this level. All right. So this is how we name time frame. We name time frame we name IPA and EPA according to the time frame that you are. Okay. Now, see this sell-off that happened. This is a 15 minutes EPA. Can you see? Hello? All right, no problem. This is a 15 minutes EPA right here. Okay. 1 hour, let's see 1 hour. It is not. That means it's only a 15 minutes EPA. Okay. If I'm selling, my reason for sale is going to be what? Based on 15 minutes EPA. Let's see 5 minutes. We don't use 5 minutes EPA that much, but you see, it's also a 5 minutes EPA. Do you understand me? So you are going to mark your time frame based on, you're going to mark your EPA based on time frame. Do you understand now? All right. Okay. What is confusing? Remember, I told you, don't forget, we mark EPA and IPA based on time frame. If you are going to mark your time frame, you are going to indicate right here, this is a what? A 15 minutes EPA. Okay. This is a 15 minutes EPA. And let's see. You see this sell-off that happened, right? You see this sell-off that happened right here also. Okay. This is a 15 minutes EPA. Okay, because you have this being filled. Let's see the 1 hour time frame. Okay, it is not an EPA on 1 hour. Everything is fully efficient on the 1 hour time frame. So it is only a 15 minutes. Okay, your efficiency and inefficiency is based on what? Time frame. Simple. Do you understand better? Okay. This. Anyone I like? It is not. Okay, which buy are you talking about? This buy? Okay, you have this structure, and you You have this structure and you have this structure. Okay. Yes, you are going to buy this. Remember, IP and EPA is an additional confluence. What we are more focused on is liquidity. I don't want you to confuse yourself. Okay. We are more focused on when, yes, we are more focused on when liquidity is being taken. All right. What you have here is an inefficiency that is yet to be filled. Okay. Yes. Yes. Yeah. Price price didn't feel is like a magnet. Sure. Yes. Assuming you have this, that is an IPA. What you have here is a liquidity being taken without efficiency. You can have a you can have a liquidity taken with efficiency. You can have a liquidity taken with inefficiency. What is important is when liquidity is being taken. Liquidity is being taken. That is the most important thing. Liquidity is being taken. All right. Let's see more. Uh, okay. What you have here, you have these. Come here, let me select a color. How do I select a color? Yes, price to liquidity without efficiency. No, it is not. It is not. It has not been mitigated. Look, I'm going to show you now. You have this high, right? You have this low. This high has not been mitigated. Where? The only time this has been mitigated is this. If you are talking about this price action right here, this did not get mitigated. This low did not mitigate this low, creating inefficiency below. Okay. So you can have a liquidity being taken, for example, here, liquidity being taken with efficiency, or you have a liquidity taken without efficiency. What we have here is what? Just efficiency. Okay. The time you use efficiency like this for continuation is for continuation when price is what? Very, very volatile. You tend to see just mitigation, then continuation. Okay. And an example is this: when price is volatile and it needs to fill some inefficiency or it's seeking a liquidity below. Okay. Do you understand? Are you sure? So EPA and IPA is based on time frame. You need to understand that time frame is important. Okay. So if a low is mitigated or a high is mitigated, then price gives you an EPA. But what you have right here, this is not an efficient price action. No. Okay. 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 Oh, yes, this is an efficient price action. What you have here is a, an efficient price action. You are right. This is an efficient price action on what? Daily. But you see have the above. If you switch to daily time frame, right? This is September 2023. Let's go to the September 20. I'm going to explain to you now. September 2023 on the chart. September 2023. September. Is this September? Is this 2023? Yeah, this is last week. Yeah, I'm trying to see the price action. It looks familiar. Very, very familiar. So let me show you what it is. You're going to see that that EPA is a daily EPA. All right. On the daily time frame, look, very, very perfect. This is a daily efficiency. On the 4 hours, it is also an efficiency, but it belongs to daily time frame because you see how what inefficiency above right here. Okay. Okay. I don't want I don't want you to I don't want you to confuse yourself, bro. Okay. What you need to understand is that price gave you an efficiency. If you are marking your IPA, it has to be based on time frame. I'm giving you an objective way to look at EP and IPA so that whatever, even if I ask everybody in the community to give me an IP and APA, they are going to give me the same thing. All right. Don't confuse yourself. All right. Okay. Yes, this is IPA. This is an this is okay. Now consider IP and APA not with structure, just an imbalance. This gap you have within price. Okay, not with structure. Okay. If you have this also, let's say, let me show you an example of IPA based on structure. So you mean to tell me that what you have here is an efficient price action? If because uh, if this has been, let's say for example, if you see this as an EPA, all right, this is an EPA. Let's see daily time frame. It is not an EPA, okay? What I consider as EPA, what I'm teaching you, is when you have candles being properly filled. And efficiency is when candles are properly filled. You have this also as what? If this is being mitigated, this is an efficient price action. My definition of IPA and EPA is when candles are properly filled, not structure. Forget forget whatever you've learned before. Just focus on what I'm teaching you. Do you understand? Surely, sure. I'm going to do that. Sure. Okay. Do you mean like this? H1 Euro USD. Okay. What's your question? Okay, yes. Price didn't mitigate the supply and demand, right? Now, let me show you something. Remember, I told you 15 minutes time frame is our time frame, right? 15 minutes for this four time frame is our directional time. Okay. What did I tell you? I told you price is interested in liquidity first before mitigation. If you have a liquidity taking and you have mitigation, that is a plus. We are only interested in liquidity. Look, you have this low been taken. Now you have what? Uh, on the 15 minutes time frame, what you have right here is an efficient price action. Let's see. Can you see? All right. Liquidity first. If you have an efficiency, fine. On this, price didn't give you an efficiency right here. Okay, it didn't mitigate this. But what? We have a liquidity being taken. Liquidity first. Liquidity first. Remember, liquidity first. Focus more on liquidity and don't worry about inefficiency. Okay. The one you marked right here, liquidity first, then it gave you an efficiency on the 15 minutes time frame. I'm not sure you understand. Yes. That's true. The thing is, whenever price is volatile, you need to go low. You need to go lower to find an entry. Okay. Whenever price is volatile, you need to go down to 15 minutes, 5 minutes to find a liquidity or an efficiency to work with. You can't just see price cannot just react to something. Like price cannot react to nothing, they move. Okay. No, I don't care about that. Do you understand now? All right. Later, if you have questions, bring it to me, please. All right. So let's see the criteria in selecting a valid zone. Now we have 4 criteria in selecting valid zone. We have 4 criteria in selecting a valid zone. And I'm also going to show you. Now, the first criteria is what? A break of structure. The first criteria is break of structure. For you to consider a zone valid, it has to take out the preceding structure point. It has to break a structure point. Okay? The second criteria is liquidity. And under liquidity, we have what? We have 3 different scenarios. Okay, under liquidity, we have 3 different scenarios. The first scenario is that your supply zone should take a liquidity point or a structure point before breaking structure. That is the first scenario. It should take out a liquidity point before breaking structure. The second scenario is that your supply or demand zone should have a liquidity point before the mitigation. This is what we're talking about. Should have a liquidity point before mitigation. This is your supply zone, your demand zone. The third criteria is the combination of the first and the second, which means you need to have what? A liquidity taking, a break of structure, and has the liquidity before the mitigation. This is the strongest of them. Okay, should have a liquidity before the mitigation, and also what? Takes liquidity before breaking structure. Then the third criteria is an inefficient price action before the mitigation of your zone. If you have a gap between the mitigation of your zone, it gives what? A stronger confluence. A magnet, IPA is a form of liquidity because it always attracts price. The fourth criteria is order flow, the overall flow or direction of price. The overall flow or direction of price. Okay? The overall flow or direction of price. That is the fourth criteria. Remember, the first criteria is break of structure. The second criteria is liquidity. And we have 3 different scenarios under liquidity. The third criteria is IPA, and the fourth criteria is order flow. Right? So let me show you an example. Yes, it does not have to have all the criteria, but the more criteria you have, the more it is valid. An example is this: to call liquidity a swing high gives you a break of structure. Okay, gives you a break of structure and has an inefficiency before the mitigation. This is your zone. Okay. Then you have this as a valid zone because took out a structure, gives you a break of structure, and has what? An inefficiency before the mitigation. Okay. Gives you a break of structure, but in this case, you don't have a liquidity taken before the inefficiency, has a liquidity before the mitigation. So yes, yes, that's a liquidity before the mitigation. Yes, yes, okay, yes, yes, physical liquidity, yes, and internal liquidity, yes. Okay, so this is a proper way to validate your zone. There was a buy I took last week. A buy I took last week. Yes, this buy. If you check within this whole range, this is the only valid demand. Why? Because it took out liquidity. Okay, the only valid demand and gives you a break of structure, and you also have what a liquidity before the mitigation. So that was the reason why I took this buy. All right. Okay. Now let me show you more confluence for this buy. It's not just this. We have London low being taken. Okay. Outside London low, you can find a buy. Doesn't necessarily mean price because of all these are compression doesn't mean price cannot and if you notice this POI, okay, is the only POI that is valid within this range. So yes, it is the only valid one because if you check within this whole range, you are not going to see this type of POI. Okay. Um, yes, surely, surely. But 15 minutes is the lowest time frame. 5 minutes and 1 minute is for entry. Okay. The 5 minutes and 1 minute is for entry. We pick liquidity level and efficiency on 15 minutes, 1 hour, 4 hours, and daily. Okay. So zone refinement is a way of bringing down your zone to smaller units. Whenever you have a supply or demand zone, for example, you have this break of structure. Okay, sorry, you have this break of structure right here. Let's, this is a break of structure. Automatically, this becomes your what? Your supply zone, right? But zone refinement is bringing down your zone to smaller units because it took out liquidity and it has what? An IPA inefficiency that needs to be filled right here. So this is your zone refinement. Bringing down your zone to smaller units. Yes, yes, sometimes price doesn't get to refinement, yes. What is important is price. If price gets doesn't get to this, you get to like go to your 1 minute is for if you get your entry confirmation on the 1 minute time frame, you can execute even without price getting to it. Just like what we have, just like what we have right here. Price didn't get to this. Okay, because it broke structure, but price didn't get to it. I would have missed this sell also. This is not my type of sell. I want an efficiency for me to sell right here. Okay. Do you have a question? Now, at the maximum time is 3. That is the maximum for us. The maximum is 3. Any other after that, you don't have a guarantee because mitigation can occur while price is trying to give you a transfer of money. Do you understand? I will explain transfer of money later. Mitigation can occur. Let's say you have, for example, this is your value zone, right? Price can decide to give you a transfer of money after the mitigation of this zone. So you get to see this. This can happen. All right. That is price trying to transfer money down. Okay, let me show you an example. I'm not sure I can see a valid example. Just understand that. Yes. Exactly. Yes. So, like I said, it's only 3. The fourth time is not guaranteed. Price might break through. Yes, it's one time. You mean this? Yes. The first time is this. Then price came back, took out the low, right? So that is the second time. It's possible price can come the third time, but the fourth time it's going to break through. Okay. Okay. You need to make everything as simple as possible. You don't need to complicate things. You can make it very, very simple and basic. What do you mean like price giving you, let's say this is 1 hour and you get to see on the 5 minutes of you get to see this. Okay. Each one is supply within supply on same time frame. No. Give me an example. Oh. What you have is this. Okay, you have this and this. Remember when we were marking your structure, we were focused on externals, not internal. Okay, now I'm going to give you a hint. Okay, internal structure is a structure for continuation. Or I'll explain later. Okay, but what you have here, if you are taking a buy within this range, it has to be the last structure point. You don't. Yes, the last structural liquidity, not this, it's this. It has to be the last structural liquidity. Okay. Any more question? Think. If you have a question, bring it. Let's deal with it. I'm ready. Or maybe later, if you have the question, you can write it down and send it to me. Yeah. Yes, yes, yes. 50% equilibrium. I teach that before, but it is not really necessary. Yes, yes, it is not really necessary. I teach that before. Yes. No, no, no. You don't remember what I said? You don't have to complicate things. PA type 2, no, no, it's not necessary. Just focus on what you need to know. Okay. So no question. Yes, 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 yes. It's when you have efficiency, it's an additional confluence. Yes, it's basically yes, yes. Not every time. Yes, yes. We are selling because the first is price has taken what? Let's go down to the 4 hours time frame. Let me show you the reason for this sale. 4 hours liquidity has been taken. We have IP above. Then don't forget I told you pre-New York. Pre-New York, this is a perfect entry on the pre-New York. And not just that, you have a trend line build up. This is a confluence. Yes, 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 yes. Yes. Build up and transfer of money are similar, but they're not the same. Let me give you, I'm going to give you like 6 reasons for selling right here. Six. Should we? The first, the first confluence is what? 4 hours liquidity. Liquidity. No, it just, so you have this 4 hours liquidity. Then you have pre-New York entry, pre-New York. Okay. You have 3 trend line build up. You have 4 IPA below. Let's see the IPA below, which is this. Okay. Yes, yes, exactly. A 15-minute MSU. Yes, yes. All right. The problem H It is indiscriminate liquidity. It is. Okay, that is why you have timing because London high needs to be taken. London high needs to be taken. This is London high. Okay, can you see? Liquidity resting above London high. Yes. Yes. Okay. Do you understand? All right. So let me send you the assignment. So you give me 10 examples of when liquidity sweep PDL and PDH. Sweep. When PDL and PDH is being swept and reversal. Then 10, 20 examples of value supply and demand. I want them to be like this. But open it like this. Like this. I want it like this. You indicate every possible detail. Inefficiency, valid supply, the liquidity before mitigation, like this, like this. Okay. You're welcome, brother. So have a wonderful day. I'm going to sleep. Sure. Sure. I'm going to do that. I'll do that. I'll send from students. Okay. All right. Today is Wednesday. I don't know if it's possible by weekend or Monday. All right. No problem. No problem. You're welcome. Have a nice day, brother. Bye.